Welcome to Policy on Demand. I'm Jennifer Spang. The One Big Beautiful Bill Act is now officially law, introducing significant tax and financial reporting considerations for companies with operations in the U.S. Joining us to discuss are Jen Schiellack and Eric Suplee from PwC's National Tax Accounting Services practice. Jen, Eric, welcome.
Thank you.
Great. So, Eric, I'm going to start with you. Before we dive into the details of the provisions, let's talk about what the questions are that you're getting most.
Thanks, Jen. I'm really happy to be here. Companies are really trying to think through their financial reporting impact. And the financial reporting impact to a company will ultimately depend on their specific facts. And we've seen a wide variety of impacts. So let's level set on the basics. US GAAP requires that all tax effects of a change in tax law be recorded in the period of enactment, which for US GAAP purposes occurred on July 4th. All tax effects from a change in tax law on existing current or deferred tax balances, including changes in valuation allowances, would be recorded discretely to continuing operations. Since the passage of the bill, companies have primarily focused on their quarter close. For many companies, the enactment occurred after the end of their reporting period, but before the release of their financial statements. That meant that they needed to consider it from a subsequent event standpoint. And from a subsequent event standpoint, we saw a couple of things. For most companies, they indicated that they were still assessing the impact. Other companies disclosed the impact of, they were more specific, and they went into R&D credits, they went into interest rules, they talked a little bit about depreciation and the various international provisions. Now that the most recent quarter is behind us, many companies are now starting to go through their detailed analysis, and they're looking at the impacts that will need to be recorded in the next period.
Got it. So maybe with that, Jen, I'll go to you. Obviously, the modifications to both the domestic and international provisions, the TCJA provisions, are expected to be probably the greatest change or have the biggest impact. So as companies are assessing that, what are the financial reporting considerations we might expect?
So let's start with addressing the three domestic TCJA provisions, which relate to 100% bonus depreciation for property, plant, and equipment, the expensing of research and development expenditures, and then the limitation on interest deductibility. With all three of those provisions having retroactive effective dates back to the beginning of the year, most companies are going to have an effect that needs to be recorded to the deferred income tax and current income tax payable accounts within this reporting period. And that's generally consistent with the disclosures that Eric had mentioned. Now, as companies are thinking about the effects of those three provisions, the other key consideration is going to be taking into account any potential knock-on effects those provisions could have. So think about FDII or even CAMT. Some companies are now finding themselves subject to that taxation. With the international provisions, all of the more significant changes, so think about GILTI, BEAT, and FDI, those changes will take effect for tax years beginning after December 31st, 2025. But even though there's a delayed effective date, there may still be a 2025 financial statement impact that needs to be recognized depending on a company's facts. Generally, those international provisions that I mentioned are accounted for as a period cost. Some companies may have, however, made an accounting policy choice specific to GILTI, where they may be recognizing GILTI deferreds. So for those companies, they will need to remeasure their deferreds to take into account the prospective changes to the GILTI regime. And then when we think about both the domestic and international provisions, the other key area is going to be the valuation allowance assessment. And there are really a number of factors that could impact a company's assessment. So that's going to be one to carefully evaluate.
Yeah, well, let's stay with that and unpack that a little bit. Obviously, valuation allowance assessments come with a host of challenges for companies, even in what might seem like the most straightforward effect patterns. So as we think about this One Big Beautiful Bill Act and all of those provisions you just talked about, what are we looking at in valuation assessments? Unpack that a little bit.
So you're absolutely right that the valuation allowance assessment is a challenging exercise. And with the OB3, what makes it particularly complex is the interconnectedness of the provisions. So you take the interconnectedness and add in the inherent subjectivity that's often required in determining whether or not a company's deferred tax assets are realizable. This is going to be something that companies are going to need to carefully monitor and really kind of perform a scheduling analysis on. But if we kind of take the international and domestic provisions, starting with the domestic provisions that I had mentioned earlier, when you look at the potential changes that they could have to a company's overall net deferred tax position, that's kind of step one to evaluate, depending on how a company intends to treat domestic R&E expenditures or how the limitation rules may ultimately impact their 163J computations. A company could have a significant reduction, if not elimination, to those respective deferred tax assets. With bonus depreciation, that can create additional deferred tax liabilities. That is one of the 4 sources of income that may be available to support realization. With the international changes, that could also affect one of the 4 sources of taxable income, which is the projections of future taxable income. So you can start to see with both the domestic and international provisions that where the complexity lies, and that's why the scheduling analysis is going to be really important. Within that analysis, there's really 2 key factors that companies should be thinking about. One factor is the limitation rules that exist under law. So you can think about the interest limitation rules as one example. Foreign tax credit limitation rules would be another example. 163J, I think, is one area in particular that companies are going to have to carefully evaluate. It's not an easy exercise to determine if you can utilize your interest carry forward, or even if you're originating 163J limits in 2025. And then the other key factor within the scheduling analysis is those interactions that I had mentioned. You know, we are hearing some companies that may be expensing domestic R&E that could create favorable benefits for FDII, but could cause the company to now be subject to BEAT or CAMT. So within that valuation allowance assessment, really ensuring that you've captured all of those interactions is going to be critical for companies, and to ensure that you're also just taking a holistic approach when determining your valuation allowance conclusions.
Yeah, and for some companies, it's the first time dealing with something like KMT, right? So I think that the valuation allowance considerations, policy choices, things around that can be challenging. So Eric, Jen has just walked through a number of the more detailed provisions, but what other areas should we be thinking about from the Act where there might be some financial reporting implications?
Yes. I'm going to break it down into 4 different categories. Jen highlighted what are expected to be the most significant provisions for most companies. There are a number of other changes that could have an accounting impact. For example, changes in the IRA energy credits, limitations on executive compensation and the deductions there, the CFC look-through rules, and there are additional limitations for charitable contributions. Although we're not going into detail on all of those provisions, it is important for companies to evaluate those changes. From the state side, companies must also consider the impact that the legislation may have on state and local income taxes. Analysis will need to be performed on a jurisdictional basis. Some states automatically conform to the federal legislation, while others require separate legislative action, UTPs. As always, companies need to consider their positions and determine whether there are any uncertainties, as there are certain areas that are inherently subjective. Future regulatory guidance is also expected, so companies will want to be mindful and monitor for future guidance so that they can assess it in the appropriate period. The last area to consider is disclosure. As I mentioned previously, companies were probably in the position where they were looking at a subsequent event disclosure, and now they're actually going through and accounting for the impacts of the legislation. They will want to assess and update any of their disclosures associated with it.
Got it. And I'm sure focus on transparency. So
Absolutely.
we'll see that evolve, I'm sure, as the year goes on. So, Eric, I'm going to stay with you, but I'm going to shift gears a little bit and talk about something that didn't make it into the final legislation. So, obviously, leading up to the enactment of the One Big Beautiful Bill Act, there was much discussion around Section 899, which was introduced by the House Ways and Means. Again, obviously, was not part of the final bill, but that was really dealing with retaliatory measures against taxes, foreign taxes like the UTPR or the digital services tax. It didn't make it in as a result of a G7 agreement in June. But how should companies be thinking about that agreement in financial reporting, and what should we be looking for as we look ahead for the next few months?
Yeah, this is coming up quite a bit. So in short, Pillar 2 still needs to be considered. The agreement is just that. It's an agreement. It is not considered law. Each country will have to enact changes for how US-based multinationals will be taxed under the Pillar 2 regime, and they'll need to do that into their local law. Before that happens, the OECD is expected to release additional guidance. The timing of that guidance is very uncertain. Each country will need to adopt that guidance into their local legislation. From a financial statement perspective, what that means is until it is enacted into law, US-based multinational companies must continue to make their best estimate of the Pillar 2 outcomes for both the transitional CBCR safe harbor and the full globe computations for the 2025 year end and going into 2026. Given the uncertainty of when we will see countries and how they will respond to the G7 agreement, and also, don't forget that Congress has indicated that Section 899 is not completely off the table. It could be reintroduced. Companies will want to continue to monitor and developments in this area.
Very helpful. So staying with this theme of like some of the more unique things that are going on or things that we'll have to be watching, clearly tax departments are having conversations about the act with the C-suite. What are some of the messages that are being delivered now or should be thinking about as tax departments are having those conversations?
Yeah. While not related to OB3 legislation, we have had some questions on the draft appropriations bill released in the House last month that proposed to cut the FASB funding unless it withdraws the new income tax disclosure ASU. While the House subcommittee is in support of the funding cut, there is likely to be opposition in the Senate, which could prevent the proposal from being a final bill. Timing of that final bill is also uncertain. Given the uncertainty, companies should continue to focus on preparing for the adoption of the ASU, which will become effective for 2025 year-end financial purposes for companies that have a calendar year-end. At this point, those companies have less than 5 months to evaluate their global tax profile, data processes, and systems to meet those disclosure requirements. And then with regard to the OB3, modeling is going to be key to understand not only the cash tax impact, but the effects that it might have on the effective tax rate and their financial statements.
Got it. Yeah, and reporting, you mentioned disclosure before, it's pervasive, right? So there's a lot to think about there. All right, so before we completely wrap, I'm going to come to a question for both of you, and Jen, maybe I'll start with you, and then Eric, get your thoughts. But what is one step you're recommending companies take right now?
To me, it's really going back to what I had highlighted earlier, and that's performing the scheduling analysis. Given the number of provisions that were included in the bill and the number of interactions those provisions can have, that scheduling analysis is really going to help a company identify all of the potential implications as a result of the change in tax law and also ensure that they're accounting for it in the proper period.
I 100% agree with you, and I would just put in a big plug to the last point that I made. Do not lose sight of the income tax disclosure ASU.
Got it. Great. Well, Eric, Jen, thank you for joining me today. I am sure this is a conversation we'll be revisiting for the rest of this year and as we look forward. So thank you for joining me. And for our viewers, you can find the latest Policy on Demand episodes in the description of this episode and on our website. Also, we have an upcoming webcast on August 19th on the credits and incentives landscape after the enactment of the One Big Beautiful Bill Act. So join us. You can find the registration link for that webcast in the description of this episode. As always, we appreciate you spending this time with us. Take care.